In this video, I'm going to show you a 7-step guide on how you can work towards achieving financial independence and retire early in Australia. So if you're new to investing and curious about the FIRE movement, this guide will walk you through everything you need to know from calculating your FIRE number and increasing your income to keeping your FIRE journey on track through the ups and downs. By the end of the video, you'll have all the knowledge and strategies needed to begin your FIRE journey. Now before I begin, a quick disclaimer, I am not a financial advisor and this video is not financial advice. It is purely for educational and entertainment purposes only. While I will use hypothetical scenarios and assumptions in this video, you should consider your own circumstances and make your own financial decisions. If you're unsure, you can go see a licensed financial advisor for professional advice. And with that out of the way, let's get started. Step 1. Understand the FIRE movement. So what is FIRE? FIRE stands for Financial Independence and Retire Early. The term FIRE is a financial strategy that focuses on aggressive saving and investing to achieve earlier retirement. It was made famous in this book, Your Money or Your Life, in 1992 and has become quite popular in the last decade. The main goal of FIRE is to reach a point where your investments generate enough passive income to cover your living expenses indefinitely. This allows you to retire decades earlier than the traditional age, which is around 65. The FIRE movement has evolved over the years, offering different paths based on lifestyle goals, risk tolerance, and income levels. Whether you want to retire frugally or enjoy a luxurious lifestyle, there's several types of FIRE strategies you can follow. I'll now go through some popular strategies. 1. Traditional FIRE, the classic approach. This is the original FIRE method, which involves saving aggressively, usually around 50 to 70% of income, investing it, and retiring early. It follows the 4% rule where you withdraw 4% of your investment per year to cover all expenses. For example, if you need $40,000 per year, you must save $1 million before retiring. This is for people who want to quit their full-time work completely and live off their investments. It's for those who are comfortable with moderate spending in retirement. So no fancy boats, houses, or supercars, just a normal lifestyle but without working for a paycheck. For example, you live a normal life in the suburbs in a classic Australian 4x2 house, you have some hobbies, and you go traveling every year. 2. Lean FIRE, frugal early retirement. This is achieving FIRE with minimal expenses, which is typically less than $40,000 per year. If you can live on $30,000 per year, you only need $750,000 saved versus $1 million for traditional FIRE in the previous example. It focuses on frugal living, low-cost housing, and minimal lifestyle spending. It's for people willing to cut costs and live a minimalist lifestyle. Some people don't need much to be happy. They value their freedom more than being able to eat fancy food or drive fancy cars. It's also ideal for digital nomads or people living in low-cost cities like Bali, where the Australian dollar has greater purchasing power. For example, you can live in a tiny home, do van life, live in a rural area, or a cheaper country. 3. Fat FIRE, luxury early retirement. This FIRE method is for those who want a comfortable, high-end lifestyle when they retire. So it's basically the opposite of lean FIRE. It's for people who want to have their cake and eat it too. As you can imagine, it requires higher savings to support travel, luxury homes, and other premium items. It generally requires $2 to $5 million savings depending on where you want to live. If you want $100,000 per year to live well, you'll need at least $2.5 million saved up. This is for high income earners who can afford to save and invest more money. It's for those who want to retire early without sacrificing luxury. For example, you can live in a nice house in a major city, travel frequently, and have many expensive hobbies. 4. Coast FIRE, let time do the work. This method involves saving and investing aggressively early in life, then stop adding money. You just let compound interest grow your wealth over the decades. For example, if you save $150,000 by age 25 and invest it with an assumed 8% annual return, that money would grow to over $1 million by age 50. And that's just from a single lump sum investment without any additional contributions. Then you coast the rest of your life. You keep working only for daily expenses until your investments naturally reach FIRE. This is for people who don't want to aggressively save forever. People who enjoy working but want financial security later on. For example, you save heavily in your 20s and 30s, then switch to a low-stress job and coast until you reach full FIRE. 5. Barista FIRE, semi-retirement with side income. The aim here is to retire early but still work part-time or have a side hustle to cover some expenses. It keeps more income coming into your account for longer, which allows for more flexibility and mental security. The term barista FIRE comes from a part-time job like a coffee barista at Starbucks in the United States, which is known for offering health insurance and other work benefits to part-time employees. In Australia, we already have a great public healthcare system, but there are other nice work benefits like superannuation and paid leave. Plus the social connections you get by coming to work that you may not get being fully retired. This strategy allows for lower savings required for FIRE while keeping these work benefits. If you need $40,000 per year but earn $20,000 from part-time work, you only need to save $500,000 instead of $1 million. This strategy is ideal for those who enjoy their job, passion projects, or side hustle. For example, teaching yoga, running a small business, or working at a coffee shop a few days a week while having more days off than the average Australian. 6. Slow FIRE, gradual approach to financial independence. This is a more relaxed approach to FIRE, focusing on work-life balance. Instead of aggressively saving 50% plus, you save at a slower pace while enjoying life. It takes longer to reach FIRE but avoids extreme frugality or burnout. Instead of retiring at 40 with $1 million, you might retire at 50 with $1.5 million, giving you more security. This strategy is ideal for people who want financial freedom but don't want to sacrifice everything right now. It's for those who enjoy their career but want to reduce work hours over time. I think many Aussies who are trying to get ahead may already be doing this without realizing. For example, you spend your 20s making and saving money, but at the same time you enjoy yourself by going out with your friends and traveling. I personally think this is a more balanced way to live. Rather than sacrificing too much when you're young, eating instant noodles for every meal, and generally being miserable in the pursuit of financial independence. 7. A different FIRE. Financial independence, recreational employment. This is when you reach financial independence but choose fun or meaningful work instead of full retirement. I also like this one very much because I don't ever see myself fully retiring. With this method, you work in passion-driven jobs like art, coaching, and blogging without worrying about income. It's a more spiritual approach to FIRE. This is ideal for people who want purpose, not just money. Those who like working but want more freedom and flexibility. For example, a former lawyer who reaches FIRE at 35 and chooses to teach yoga or write books instead of retiring completely. 8. Geo arbitrage FIRE. Move to a cheaper location. This involves people reaching FIRE, then relocating to a lower cost area to get more value for their dollar. Some move to a cheaper state, for example Sydney to Adelaide, but I'm seeing more Australians move overseas to places like Bali, Thailand, Vietnam, and the Philippines. If you move to these locations with lower cost of living, your Australian dollars will be more valuable and you won't need as much to retire. For example, if you need $50,000 per year to live in Australia, you may only need $25,000 per year in Bali, cutting your FIRE goal in half. This is ideal for those who want a high quality of life at a lower cost and don't mind moving for it. It is also useful for digital nomads and remote workers. For example, you work and invest until you reach your FIRE number, then move to a place with a lower cost of living where your passive income covers all expenses. So these are 8 different types of FIRE, although there are probably more options out there. I would encourage you to research further to find out which approach suits you best. Remember, you're not locked into any single method. You can adapt your strategy as your life circumstances change. FIRE isn't a one-size-fits-all journey. You can even combine different components of each strategy that suits your lifestyle. Step 2. Calculate your FIRE number. Your FIRE number is the amount of money you need in investments to retire and live off the returns indefinitely. It's typically calculated based on the 4% rule, which suggests that you can safely withdraw 4% of your total portfolio every year without running out of money. You can use the rule of 25 to calculate your FIRE number. Firstly, determine your annual expenses. This is how much you need per year to cover all living expenses when you retire. So include things like housing costs, utilities, groceries, healthcare, entertainment, and travel. Basically all the things you need to enjoy life. Secondly, multiply this number by 25. Your FIRE number equals annual expense times 25. This assumes a 4% withdrawal rate. For example, if your annual expenses equal $40,000, your FIRE number is 40,000 times 25, which is $1 million. So this means in this example, you'll need $1 million invested to retire. However, there is an argument in the FIRE community that the 4% rule may be outdated due to economic changes, high inflation, rising costs, longer life expectancies, and market volatility. So if you want a more conservative FIRE number to account for these extra risks, you could use a 3% withdrawal rate instead of 4%. You can simply adjust the 25 rule to the 33.3 rule. So for example, if your annual expense is $40,000, your new FIRE number equals 40,000 times 33.3, which is approximately $1.3 million. You wouldn't need that much invested to retire safely at a 3% withdrawal rate. And of course, you can adjust these numbers based on the type of FIRE you're working towards. So for example, for fat FIRE, you'll require higher expenses so you can multiply by more than 25. For lean FIRE, you would require lower expenses so you can actually multiply by less than 25. It's not a one-size-fits-all. You can base your number on how much you are willing to compromise or not compromise. Step 3. Maximize savings. The FIRE movement is built on the idea of saving aggressively to reach your FIRE number. The core of FIRE is building wealth through investments, and the more you save, the more you can invest. The faster you build your investment portfolio, the sooner your assets generate enough passive income to cover your living expenses. Some people take savings to an extreme. I hear of some people living on instant noodles and never going out for entertainment or holidays just so they can reach FIRE quicker. If you're willing to make that sacrifice, then more power to you. However, I don't think it's a good way to live. I prefer a bit more balance. So here are some things I would do to maximize savings while still being able to enjoy life. 1. Pay off all high interest debt. This includes credit card debt, card loans, and personal loans with interest over 6%. Some credit cards charge you over 20% in interest. So paying off these debt gives you a guaranteed tax-free return in saved interest. 2. Have an emergency fund. An emergency fund consists of 3 to 6 months worth of living expenses set aside to protect you from unexpected costs like losing your job, a medical emergency, or your car breaking down. I like to think of an emergency fund as insurance against bad luck. As you probably know, life isn't always sunshine and rainbows, and there will be times when having a large sum of money can solve major problems you have. So always have an emergency fund ready for when that day comes. 3. Use high interest savings accounts. Keep your excess cash, including your emergency fund, in a high-interest savings account. If you have a variable home loan, put the money in an offset account. Make sure every single dollar you have is working hard to earn more money for you. Keeping money in a normal transaction account means it loses value over time due to inflation. With a high-interest savings account, you're at least earning interest. If you have a job, have your salary paid directly into a high-interest savings account. 5. Cut unnecessary expenses. Many Australians waste money on unused subscriptions, redundant services, and avoidable fees. By cutting these expenses, you can significantly boost your savings. Here are a few things you can do. Compare and switch providers for internet, phone, and insurance to secure better deals. Take advantage of cashback apps and discount codes when shopping online or in stores. Set up automatic bill reminders to prevent late fees. Use fee-free bank accounts and skip ATM withdrawal charges. Review your expenses regularly to identify and eliminate unnecessary spending. 5. Automate savings and track expenses. Tracking where your money goes ensures that you stay in control of your finances. Use a budget spreadsheet to track all your current and upcoming expenses. If you don't have one, I'll leave a link in the description to a free one you can use. You can set up automatic transfers to savings or offset accounts each payday to ensure your money is not just sitting idle in a transaction account losing value. Follow a structured savings plan such as the 50-30-20 rule, where 50% goes to needs, 30% to wants, and 20% to savings. Your savings rate will depend on the type of FIRE you're going for. So if you're going for something like F.I.R.E, you'll probably need to increase your savings rate. Step 4. Increase your income. Achieving FIRE requires not just saving money, but also increasing your income to invest more and reach your FIRE number faster. Please remember, while there's a limit to how much you can save, there are no limits on how much you can earn. I always try to focus on earning more rather than saving more. In Australia, there are 3 main ways to increase your income. 1. Negotiate a pay rise. One of the fastest ways to increase income is earning more from your current job. So you can research industry salary benchmarks on platforms like Seek. Document your achievements and how you add value to your employer. Don't be scared to ask for a raise at the right time, such as after a successful project or performance review. And more importantly, be prepared to switch jobs if your employer won't meet your market rate. In fact, research shows that changing jobs typically results in larger salary increases compared to staying with the same employer for a long time. 2. Upskill and get higher paying roles. Higher income jobs lead to faster FIRE progress. Invest in skills that are in high demand in Australia. Here are some high demand skills currently in Australia. Tech skills, for example AI, cybersecurity, coding, and data analytics. Finance and investing, for example financial planning, accounting, and business analysis. Healthcare, so nursing, physiotherapy, and aged care. Trades, for example electricians, plumbers, and carpenters. Construction, for example civil engineers and construction managers. Although some of these roles require a university or TAFE degree, there are plenty of free online courses on platforms like Udemy and YouTube that teach coding and other tech skills. So I would encourage you to take advantage of these paid and free courses to make yourself more valuable than your competition when applying for high-paying roles. And 3. Start a business or side hustle. Building a side income stream can help you invest more aggressively for FIRE. Since you own the business, you get to keep 100% of the profits. Some ideas include freelancing like graphic design, copywriting, web development, and consulting. You can also do tutoring, both online and in person, in subjects like English, maths, or coding. You can try reselling, so flipping items on Facebook Marketplace, eBay, or Gumtree. You can try content creation like me on YouTube, or you can do blogging if you don't want to show your face. There's ride sharing and delivery like Uber, DoorDash, or other delivery services. You have online businesses like drop shipping, print on demand, and e-commerce. There's a lot of free information online on how to do these things. So go out there and give it a crack. What's the worst that could happen? If done right, a side hustle can eventually replace your traditional job, allowing for more control and flexibility over your income. And this will definitely help in your FIRE journey. Step 5. Invest in income-producing assets. To reach your FIRE number, you'll need to invest in income-producing assets. In Australia, the 2 most popular choices are shares and real estate. Both have proven to be historically strong asset classes. While I personally invest in both and won't go into which is better overall in today's video, I have noticed that the Australian FIRE community generally prefers shares over real estate. Shares can be particularly effective for achieving FIRE because they offer growth potential, passive income, diversification, and long-term wealth accumulation. Let me further explain why shares are considered well-suited to achieve FIRE. 1. Low barrier to entry. If you're a beginner or don't have much money to start with, investing in shares is an easier way to begin since the barrier to entry is so low. Anyone with a smartphone can sign up to an online investing platform and start investing in shares within minutes. You can start investing in shares with as little as $50 to $500. In contrast, buying property in Australia typically requires a 20% deposit. This could mean tens or hundreds of thousands of dollars upfront. FIRE strategy. How this applies to your FIRE strategy? Well, this allows you to start your FIRE journey literally right now instead of waiting around and trying to save enough. 2. High long-term returns. Historically, the stock market grows at an average of 7 to 10% per year, adjusted for inflation. In fact, this Vanguard article states that the Australian stock market has averaged a 9.1% annual return over the last 30 years, and the US market averaged 11.1% per year over the same period. So compare that to not investing and parking your money in a savings account in Australia, which historically returns around 2 to 5%. So here's an example. If you invest $500 per month in an ETF or index fund that tracks the entire market, returning 8% per year, in 20 years, you would have $275K. In 30 years, it would grow to $680K. And in 40 years, it would reach around $1.5 million. And you could get there even faster if you contribute more per month. FIRE strategy. Many Australians like to invest in low-cost index funds like the ASX 200, which tracks the top 200 Australian companies, or the S&P 500, which tracks the top 500 US companies. The easiest way in Australia to invest in index funds is through an ETF listed on the ASX. Some examples include a combination of VAS, A200, ROZ, VGS, IVV, and all-in-one ETFs like DHHF and VDHG. 3. Compound interest. Compound interest, often called the eighth wonder of the world, allows money to grow exponentially over time. While simple interest only earns returns on the initial investment, compound interest generates returns on both the original amount and the past earnings. This snowball effect makes it one of the most powerful tools for building wealth. With compound interest, the earlier and longer you keep your money invested, the more it grows. The key drivers of this growth are, the earlier you start, the more time your money has to compound. And also, reinvestment. Earnings are reinvested, creating a cycle of increasing returns. For example, let's open up this trusty compound interest calculator. I'll leave the link down in the description so you can go ahead and play with it yourself. So let's say you invest $10,000 into an index fund or ETF with an assumed 8% annual return. After 10 years, you would have around $21,000. After 20 years, around $46,000. After 30 years, over $100,000. The money compounds because each year, your earned interest gets automatically reinvested, creating a snowball effect. Now let's say you dollar cost average $1,000 per month into this ETF after the initial $10,000 investment. Assuming the same 8% annual return, after 10 years, you would have around $195,000. After 20 years, around $595,000, and after 30 years, over $1.4 million. As you can see from the calculator, the real power of compounding kicks in after decades. After 30 years of investing, you'll accumulate over $1 million in total returns. This demonstrates why investing early combined with regular contributions can be so effective. And of course, the more money you can invest, the faster you can reach your FIRE goal. So your FIRE strategy is, invest ASAP and let compound growth do the heavy lifting. If you can manage to invest more and earlier, your portfolio will compound way faster. You can automate your investments using dollar cost averaging every payday and let compounding do the work. 4. Passive income from dividends. Many stocks, especially blue chip companies or ETFs that track these companies, pay dividends. A dividend is a portion of the company's profits shared with investors. In Australia, they are usually paid out quarterly. This can be ideal for retirees who want to live off the quarterly dividend payments that certain stocks and ETFs provide. For example, VAS and VGS are popular ETFs in the Australian finance community because of their history of growth and consistent dividends. For example, if you own $1 million in dividend stocks or ETFs paying a 4% yield, you would get $40,000 per year in passive income. So your FIRE strategy can be reinvest dividends early on in your FIRE journey to compound your portfolio growth, then live off the dividends in retirement when you hit your FIRE number. 5. Low effort and easy diversification. Unlike other assets like real estate, stocks require minimal maintenance. You buy it, and that's it. There's no tenants asking you to repair a broken tap on a Sunday. ETFs allow you to own hundreds and thousands of companies at once. For example, if you invest in VAS, you're investing in the top 300 Australian companies. And with VGS, you're investing in over 1,400 companies in first world countries like the US, France, and Japan. Global diversification can protect you against market downturns in one country or sector. You can easily spread out your risk by choosing the right ETF or combination of different ETFs. So your FIRE strategy can be dollar cost averaging into index funds over time to reduce risk. 6. Liquidity and flexibility. Unlike real estate, shares can be sold instantly when needed. There is no waiting for months to sell a house or deal with transaction costs. You have the ability to rebalance or shift investments quickly based on market conditions or personal needs. So your FIRE strategy can be keep a mix of stocks and cash for financial security and easy liquidity. 7. Tax advantages. In Australia, the dividend imputation system means some dividend stocks pay franked dividends, which provides a tax benefit. Holding stocks for more than 12 months gives you a 50% discount on capital gains tax. Since FIRE requires you to invest long term, you will likely be able to take advantage of this discount when the time comes. Investing through a self-managed super fund or ETFs can offer even more tax benefits in Australia. So your FIRE strategy can be invest in tax-efficient ETFs and frank dividend stocks to reduce tax. In addition, you can choose to max out your super if you're trying to achieve slow FIRE, where you are still working and enjoying your life. And if you're looking for an easy-to-use investing platform to invest in shares or ETFs for your FIRE journey, check out the Moomoo app. They're a beginner-friendly online broker that allows Aussie investors to invest in both the Australian and US stock markets. There are 3 things I like about them. 1. They're CHESS-sponsored. This means your shares are registered directly under your name on the ASX. This provides better security if the broker goes out of business in the future. Please note, not all online brokers offer this. 2. They charge very low brokerage fees. They charge a minimum of $3 per trade for Aussie stocks and a minimum of 99 cents per trade for US stocks. This is one of the lowest rates in Australia. And 3. They recently released an auto invest function that automatically buys your favorite stocks or ETFs for you every month or fortnight. This function is for both ASX and US stocks. All you have to do is create an auto bank transfer from your bank to your Moomoo account. This is ideal for beginners who want to automate their investing through dollar cost averaging, which will help them achieve their FIRE goal. And since you're my audience, Moomoo has kindly organized some juicy sign-up bonuses for you. Right now, if you sign up using the link in the description, you'll receive up to 12 free random stocks when you make a qualified deposit and keep a minimum account balance for 30 days. You'll also receive 0 brokerage fees for 30 days. So that means free brokerage for a month for you to try out this app for free. And if you don't like it, no worries. You can simply withdraw your money and keep the free stocks. Please note, terms and conditions do apply, so please make sure you read them before proceeding. I'm not sure how long this offer will last, so if you're interested, use the link down below to sign up and claim all the free rewards on screen. And if you're watching this in the future, I'll provide a link to the current best offer. The sign-up process itself only takes a few minutes, then you can start investing straight away. Enjoy. Step 6. Monitor and adjust your FIRE plan. Reaching FIRE requires you to monitor your progress and make adjustments along the way. As markets fluctuate, expenses change, and your lifestyle goals evolve over time, you'll need to fine-tune your FIRE strategy. Here are some ways to effectively track and adjust your path to financial independence in Australia. 1. Track your net worth regularly. Your net worth is the best indicator of FIRE progress. Use a simple spreadsheet to track this. If you don't have one, don't worry, I'll leave a link in the description to a free one you can use. Also, track your investment portfolio growth, including shares, ETFs, and superannuation, your property value if you have any, and your savings emergency fund. You should also know how much debt you have remaining. So your action step can be, review your net worth quarterly to ensure you're on track. 2. Adjust your savings rate based on expenses and income. The higher your savings rate, the faster you'll reach FIRE. Your target savings rate can depend on which type of FIRE you're pursuing. For instance, fat FIRE naturally requires more savings compared to lean FIRE. Check if your income has increased, so things like raises, bonuses, and side hustles, and redirect any extra money into investments. Look for ways to optimize expenses without sacrificing lifestyle quality. So only keep the expenses that make you really happy and discard the rest. So your action step is, if you had a pay rise or windfall, use it to increase your savings rate to accelerate FIRE. 3. Rebalance your investment portfolio if necessary. Please remember, market conditions change over time, so ensure your asset allocation still fits your risk tolerance. You can rebalance between shares and cash. For example, reducing volatility as you get older and closer to FIRE. Australian versus international ETFs for diversification. Superannuation versus non-super investments for liquidity. Action step. Assess your portfolio every 6 to 12 months and rebalance if necessary to maintain the right mix. 4. Assess your passive income versus expenses. Your FIRE goal depends on your portfolio generating enough passive income to cover living costs. So you can compare dividends, ETFs, rental income, and side hustles. Adjust withdrawal strategy based on the 4% rule or lower if markets are uncertain. So here's your action step. If passive income doesn't cover expenses, either reduce spending or delay FIRE. 5. Stay flexible and adjust retirement age if needed. So my friends, please note, FIRE isn't a rigid one-size-fits-all goal. I see some people complain about recessions, inflation, and taxes. But here's the reality. You can simply adjust based on life events, market crashes, or lifestyle changes. Never assume everything will stay smooth sailing, and don't panic if something goes wrong. Always reassess, then adapt. You could always consider changing your FIRE strategy to something like Coast FIRE, so you work part-time while investments grow, Barista FIRE, where you take a low-stress job for extra cash flow, Fat FIRE versus Lean FIRE, and adjust for lifestyle expectations. So here's your action step. If needed, push FIRE back by 1 or 2 years rather than withdrawing too early. Step 7. Know your FIRE exit strategy. Achieving FIRE is just the first step. Knowing how to exit the workforce and sustain your lifestyle is equally important. You don't want to quit your job prematurely, only to find out you didn't have everything in place to be self-sustaining. What would you do then? Beg for your job back with your tail between your legs? No, we don't do that here. Your FIRE exit strategy is about deciding when and how to transition from full-time work to financial independence while ensuring your investments support you long-term. So here are some things you can do. 1. Test your FIRE plan before fully retiring. Simulate living on your projected FIRE budget for 6 to 12 months to see if it's realistic and enough to keep you happy. The last thing you want to do is quit your job too early, then suddenly realize you're not ready a few weeks later. You can also do a mini retirement or sabbatical to test your financial independence. Do you even like the idea of fully retiring and having nothing to do? I've heard stories of people retiring early and it's great for the first month or so, then they get bored out of their mind and end up going back to work. You can consider part-time consulting, freelancing, or side hustles to bridge any income gaps if you don't have enough, and even boredom gaps in case you want some kind of routine in your life. Action step. If your lifestyle feels sustainable and enjoyable, you're FIRE ready. 2. Decide on your withdrawal strategy. Your withdrawal strategy determines how you'll take money from investments. Options include 4% rule, where you withdraw 4% of your portfolio each year. As we previously discussed at the start of the video, you may need to increase that percentage, so it's not a bad idea to have a safety of margin. Variable withdrawal rate. Adjust withdrawals based on market conditions. For example, if there's a recession in a particular year, then you can adjust accordingly. Dividends and passive income. Are you going to live off your shares, dividends, ETFs, rental income, or side hustles? Make sure you have a concrete plan instead of just YOLOing it, hoping everything will be alright. Again, your strategy may depend on the type of FIRE you're trying to achieve. Traditional FIRE means retire fully and live off investments. Close FIRE means let investments grow while working part-time. Barista FIRE means cover essentials with a fun, low-stress job. Lean FIRE means retire on a minimal budget. And fat FIRE means retire with a high-spending lifestyle. Choose a strategy that matches your risk tolerance and lifestyle goals. So your action plan is, set up a withdrawal plan that ensures sustainable income without depleting your capital. 3. Maximize your superannuation for tax-free income. If you reach preservation age, which is around 60, you can access your super tax-free if retired. You can also consider a transition to retirement strategy to supplement income before fully retiring. Use a super pension account for tax-free withdrawals over 60. Action step. Review your super balance and time your withdrawals to minimize tax. I'll leave some links down below if you want to know more about these tax strategies. 4. Have a backup plan. Flexibility is key. Look, life never goes smoothly. There will always be bumps on the road and your FIRE journey is no different. So always have a backup plan if the worst were to happen. You could look at geo-arbitrage if living costs in Australia rise. You can consider moving to a cheaper city or town in Australia or another country where the cost of living is lower. You can consider part-time work or side hustles. Keep your options open for flexible income sources in those years where you may need extra money. You can also adjust withdrawals in bear markets. As I mentioned earlier, you can reduce spending during market downturns to protect your capital. During a bear market, it's the worst time to sell off your investments, so your best options are to either cut back on expenses or find additional sources of income. Action step. Prepare alternative income sources or expense cutting plans if needed. And number 5, enjoy your retirement. You have dotted your I's and crossed your T's, so now it's time to fully exit the rat race and enjoy your new retired life. You can choose to spend more time with family, focus on hobbies you've always wanted to do, or maybe go backpacking all around the world. You've earned your time freedom, it's now completely up to you. Final action step. You've worked hard for this, and now it's here. Congratulations, go enjoy it. My final thoughts. And there it is, guys. That's your 7-step guide to work towards achieving FIRE. But there's one last thing I want to note. While FIRE is an exciting goal that promises financial freedom, you need to be realistic. Many people underestimate key challenges of FIRE, which can lead to disappointment or financial stress later on. For the average Australian, achieving FIRE before 30 is not realistic. And even the ones who manage to do it without help probably lived a miserable decade eating instant noodles every day and missing out on a lot of fun things in their 20s. Those who achieve FIRE this early without being miserable are typically people who started successful businesses, worked in high-paying industries, or won the lottery. Realistically, less than 5% of people can achieve these things. However, it is very much possible for most Aussies to achieve FIRE in their mid-30s or early 40s if they're smart with their money and find ways to increase their income beyond their full-time job. So if you're interested in FIRE, I encourage you to go for it. Just remember, be flexible and enjoy life on the way. By the way, if you're enjoying this video and made it this far, comment the word pineapple down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit that subscribe button and join this amazing community of like-minded people. Also, please consider signing up for my free newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, or any cool life updates from me. And if you're interested to learn how to invest in ETFs to start your FIRE journey, check out this video on screen where I provide you a step-by-step guide on how to buy your first ETF in Australia as a beginner. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.